This video is going to cover the simplest portfolio that you can make in 5 minutes that would reduce your risk and costs while historically achieving greater returns than most professional investors. In fact, majority of investors spend a lot of time researching for the right investments and to build the ultimate portfolio, but crazy enough, the majority end up underperforming the average stock market benchmark. Jack Bogle, who is the founder of Vanguard and the index fund legend, famously states, "Don't look for the needle in the haystack, just buy the haystack." Meaning, why look for an individual stock when you can just buy an index fund that contains all of them within one purchase? This then made me think of a famous quote from Ray Dalio, who says, "Trying to time the market is harder than competing in the Olympics." So what if I told you that all you have to do to build strong wealth is purchase 3 broad-based index funds?
Sounds easy.
And in this video, I'll provide you with the best ones.
Sounds even easier.
Plus, I'll show you exactly how to allocate based on your position while showing you a real-world example that will take you less than 5 minutes to do.
It's that easy?
And to finish off the video, I'm going to cover the historical performance from each approach and include every detail you need to know about rebalancing your own portfolio. That way, when you finish, you can do this.
That was easy.
So this easy do-it-yourself portfolio is called the 3-fund portfolio. And after watching this video, you can check out the free template that I included in the description of this video to help you get started and give you some more information. But before we dive deep into things, all I ask from you is that you kindly hit that like and subscribe button below. Because it helps me out so much, here is a clip of you and I using our 3-fund portfolio. With that being said, let's start off with your first question, that is, what is a 3-fund portfolio? Now, this portfolio is known as Boglehead's 3-fund portfolio because of Jack Bogle's popularity for long-term, low-cost index funds that are great for diversification. This portfolio is known to be the lazy portfolio, but it can still get you great returns, which I'll cover in detail later in the video. So with that said, a 3-fund portfolio is simply a portfolio that consists of 3 different asset classes. This includes domestic stock, domestic bonds, and international stocks. The domestic stocks are all covered in a total US stock market index fund that consists of small, mid, to large cap stocks, and depending on the fund, may include up to 4,000 companies. Then the domestic bonds are going to come from a total US bond index fund that may consist of up to 10,000 debt securities that have maturities from short to long term. And lastly, the international stock will come from a total international index fund that excludes corporations headquartered in the US and may contain up to 8,000 companies. By purchasing these 3 index funds, you would be owning thousands of different bonds in the US and many stocks across the entire world. So as you would assume, this is great for your portfolio's exposure, and it only takes you a few minutes to do. And in fact, if you allocate toward these 3 index funds, you can match the market returns, where studies show you would actually beat the majority of pros. Because of that, let's move on to discussing the benefits to using a 3-fund portfolio. According to the S&P Dow Jones indices, roughly 92% of actively managed domestic funds underperform their benchmark over a 20-year period. And the same goes with 94% of actively managed international funds. Now, because you are purchasing index funds and you only need 1 for each asset class, you're going to be paying extremely low fees. If you were to put this in an actively managed fund, you may be paying from 0.5% all the way up to 2% a year in annual fees to own the fund, where the ones discussed in this video start at a 0% expense ratio, and the highest one goes up to 0.11%. Another benefit is that you don't need a financial advisor to do this, and that could save you about 1% a year in fees. So let's say that by doing this, you're able to cut 1 to 2% a year from fees by taking this approach. To illustrate, if you were to contribute $6,500 every year into your Roth IRA for the next 30 years, let's say that you average a 9% annual rate, you would have nearly $1 million in your tax-free account after 30 years. But if that rate got cut to 8% due to these additional fees, you would now be at $801,000, meaning you would have lost $171,000 from potential gains. And to get even crazier, if that gets cut to 7%, then you would have ended up with $663,000, which means you're missing out on $309,000 of potential gains. For some of you, that could save you a decade or more of time working. You also don't have to put that much time into it, especially after learning everything in this video. I personally think that you should save this video and the template for future reference when you begin to start building your own portfolio. Now, as long as you don't sell your positions, based off history, you could build tremendous wealth over time. A topic you'll see covered in my template is that when you lose money in the markets, you have to gain back significantly more just to get back to where you started. For example, during the Great Recession from October 2007 to March 2009, the S&P lost nearly 50%, one of the worst periods in history. And the crazy part is that's coming from an index fund, not just individual stocks you purchase. But with that, you would have had to gain 100% back just to break even. In a real example, if you had $1 million saved and invested for your retirement and you lost 50%, that means your $1 million would have dropped to $500,000. And in order to get that back up to $1 million, you would need to gain 100% back. But to cheer you up, if you kept that $500,000 invested in the S&P 500, by 2023, you would now have more than $3 million. I'm stating this to explain how crucial diversification is, and something I recently learned from Ray Dalio is, instead of allocating your investments by asset class, think about allocating them based on risk. And another significant benefit to having these 3 different index funds is that there is no portfolio overlap. This means that there are no investments that are the exact same when comparing them with each other. For example, the S&P 500 and the total US stock market index funds, when compared with each other, they have 85% of an overlap. And that is because 99.4% of the holdings in the S&P 500 fund are in the total US stock market fund. So just to illustrate the overall benefits, here you go. First off, it is simple and easy. Second, has solid diversification. Third, outbeats professionals. Fourth, you don't need a financial advisor. Fifth, because they're index funds, you do not need any actively managed funds that come with high fees. 6, requires little time. And 7, hit the like button below, por favor. With that being said, let's now move on to discussing the best funds to own. Now, I highly recommend that you check out my template that I've linked in the description below to get an overall picture, but right here are the top options I've researched for you to learn more about and see a little bit of information for each option. You can first see Fidelity and their zero funds options, where you can see the first column is the total US stock market index fund, second column is the total US bond index fund, and the third is the total international index fund. If you're curious, the highlighted orange data just means they haven't been around for a full 10 years to get a true visual on the data. If you are curious to learn more about Fidelity's zero fee index funds, I've made an entire video on that. I thought you might be interested. Links in the description below and a pop-up right here. So for those that are brand new, a 5-letter ticker symbol index fund is referred to as an index-based mutual fund. This means that you can only buy them through the direct brokerage firm that they are held on. But below that, you can see Vanguard, and what I like about Vanguard is that they have their own ETFs that you can purchase through any brokerage firm. This would be extremely convenient for some of you that aren't already on Vanguard, Fidelity, or Charles Schwab. Or even if you are already using one of those brokerages, it could be more beneficial to use ETFs on your taxable accounts because ETFs are known to be more tax efficient. I personally have index-based mutual funds in all of my non-taxable accounts than ETFs in all of my taxable accounts. Let me know in the comment section below what you favor and why. Then lastly, here are Charles Schwab's index-based mutual funds for this 3-fund portfolio. With that being said, I'm going to show you a real example of me doing this myself after I explain how to allocate the investments. First off, there are many ways that you could go about allocating your own portfolio, but the truth is, there's not one single best way to do it. It changes for everybody based on factors like your current position. How much risk are you willing to take? How long of time do you have before you are thinking to retire? So with that said, I'm going to cover 3 general approaches that you could take and even alter from. The first being more on the aggressive side, and as you can see right here, to be more aggressive, you are allocating more of your portfolio in domestic stocks than bonds or international stocks. By taking this approach, it could be seen as you having 80% stocks and 20% of your portfolio in bonds. And a factor to be aware of here is the downside risk, because from the example earlier with the S&P 500 being down 50% in the Great Recession, if you were to sell off your positions, you would have lost out on a ton of value, especially if you held it for the next 10-15 years. So this approach is only recommended if you have many years ahead of you and you can go without touching the portfolio no matter the market conditions. The second approach is a moderate approach, and I'm going to show you the real world example of me doing this in a second, but what we are going to be doing here is splitting 1/3 toward each asset class. By doing this, you are exposed to equal risk to all of the markets, and is why it is considered a safer approach than being aggressive, where you're heavily invested into domestic stocks. Then the third approach is going to be a conservative approach. This means that majority of your investment in the portfolio is going to be in bonds. You're doing this because maybe you're near retirement or you need to live off your investments. You now have much less risk of losing money. Although I think 80% bonds is a tad bit too much, at least for most people, this may be the case if you can't sleep at night because of the last recession. Now, if you're you're interested to get started with this, I've recently created an M1 Finance account because of its simplicity for allocating and rebalancing a portfolio. I simply signed up and followed the directions to build my own 3-fund portfolio that I created with only 3 index funds that were Vanguard's Total Stock Market VTI, Total International VXUS, and Total Bond Index Fund BND. As you can see, it automatically made my split 1/3 for each, and I'm going to keep that because all my other accounts are much more aggressive. From there, I simply funded the account, and where it says buy or sell, I'm able to then click buy and have it automatically purchase the entire fund for me all at once. Because of how easy this is, I'm going to personally put in a specific amount every single month automatically for me. And if you are interested to do this with M1 Finance, surprisingly enough, if you sign up using the link in the description that I have for you and deposit $5,000 within 30 days, you can get a $100 bonus. So now that you have a good idea for the types of approaches you could take and how to exactly do it, I'm going to cover now the types of returns that you could get based off each approach historically. Now, the markets have had consistent growth over time, but the past does not guarantee any future result. With that being said, let's now look at how well an aggressive portfolio using Vanguard's ETFs would have actually performed. According to Portfolio Visualizer, your aggressive portfolio of 65% domestic stock, which is VTI, 15% international VXUS, and 20% domestic bonds BND, you would have converted $100,000 from January 2012 into roughly $283,000 by May 2023. What's amazing is that you would have achieved a compound annual growth rate of 9.5%. But remember the max drawdown, and for this it is 23%. Let's now compare this to a moderate 3-fund approach. As you can see, with each asset being split evenly, a $100,000 portfolio from 2012 would have turned into roughly $211,000 by 2023. That results in the compound annual growth rate being 6.8%, with the max drawdown being 22%. It's interesting how the max drawdown didn't change that much, but the returns declined significantly. But with that said, let's now look at the conservative approach. This model has 80% in bonds, so we aren't going to see great returns, but what comes out to be is that $100,000 converted into $146,000. This came out to have a compound annual growth rate of 3.4%, with its max drawdown being 17%. So there you have it. You now know the exact performances that each approach has gotten since 2012 using the exact investments. Let's now go over a complete overview toward rebalancing the portfolio. Rebalancing your portfolio means that certain investments have either grown or lost significant value, and your risk tolerance is out of line from your original plan, thus is why you need to rebalance your portfolio. This is extremely important to understand, and I don't know any other YouTube video that goes into as much detail about a 3-fund portfolio as this video does, so let me go over a real example on how exactly this works. For example, let's say you have $30,000 invested with a portfolio that is taking a moderate approach, so that means 1/3 is going toward each asset class. This means 10,000 in domestic stock, 10,000 bonds, and 10,000 international. Let's say the US stock market has a great year and goes up 30% in the year, while your other investments stayed the same for this scenario. That means that you now have $13,000 in domestic stocks and the remaining 10,000 for each bond and international fund. That means your US total stock market now has roughly 40% coverage in your portfolio instead of 33%, and your bonds and international have fallen to 30% each. This means that your portfolio is out of balance and you're exposed to much more risk than you originally planned. That is why you need to rebalance your portfolio. This is going to constantly happen as investments are volatile, especially with time. So the first question you should ask yourself is, how often do you need to rebalance your portfolio? Although it's extremely easy and doesn't take that much time, the typical recommendation is to do it annually. I personally would recommend this so you can get more long-term capital gains taxes than short-term if it's in a taxable account. Now, as far as actually rebalancing, if you did sign up on M1 Finance, they have a rebalancing tool that will automatically do this based on the specific design of your portfolio or any specific investments you'd want changed. But if you're on another platform like Vanguard or Fidelity, you're going to have to manually sell out of your higher positions. For this case, it was the US domestic stocks, and then adjust accordingly. Especially if you are doing this with index-based mutual funds, you're going to find this to be inconvenient. But to actually do this, let's look at the previous example and go over it in details. For example, you would not sell $3,000 of domestic stock. Because your portfolio grew, you would only need to sell $2,000 and place $1,000 in each the bond fund and international fund in order to get back to the original allocation. As you can see right here, there is $11,000 in each of a total $33,000 portfolio, which means that it is split exactly 1/3 for each investment as originally planned. Now that was a lot of information covered in this video, but that should be everything you need to know to master your own 3-fund portfolio. Remember to save this video and the template for future reference, and share this video with anybody whom you think it could benefit. And don't forget, if you sign up using the link in the description below for M1 Finance and deposit $5,000, you can get a $100 bonus. And while you're at it, if you want to see my portfolio and how I allocate my investments, consider joining the Patreon community. And don't forget to hit the like, subscribe, and notifications button to be alert for future money talk content like this. Thank you.